Morning all, it's James Garish for Tuesday morning, the 5th of May. It's about 7:39 a.m. and this morning I just wanted to do something a little bit different for the morning report. I wanted to send out a recording just outlining 6 stocks that we're reasonably bullish on at this point in time. 6 stocks I like here. Most we own, some we don't. So I'll run through those very briefly. Just in terms of the market overnight, it was a reasonably positive session. US tech stocks led the gains, up around 1.3%. SPY futures are pricing a rally of about 20 points on open. We actually had a pretty bullish session yesterday in the Australian market. We on the futures market, we were down 180 points early on. We were down 90 points and we rallied about 180 points to the close. So a reasonably bullish session in the Australian market yesterday, and that is going to be built on this morning with a 20-point gain across the market. As I said, tech stocks with the leaders over in the US, and I think that dovetails very nicely into the first stock that I'm bullish on at this point in time, which is Amazon. We don't actually own this business in the international equities portfolio. We're going to buy it. This is a business that is such a phenomenal growth on such a significant scale. So we know Amazon as a business that is all about online retailing, but it's actually become broader than that in recent times. So it's trading at $2,315 a share. I know that might scare some, but again, it's a percentage basis. So we need to be looking through that price tag and thinking about what the stock can deliver moving forward. In terms of Amazon's business, and I'll just duck into its financial analysis very quickly. So to give you an idea, the market capitalization of Amazon is about $1.15 trillion, and that's in US dollar terms. So if I bring that back to Aussie dollar terms, that's about 1.9 trillion. That's equivalent to the whole market cap of the ASX. So the ASX, every company on the ASX combined, is valued about $1.9 trillion. If I think about Amazon's revenue, because I think there's a lot of talk out there about Amazon being expensive on an earnings basis. It is, but they're reinvesting in the business for future growth. So you've got to be looking at the revenue line here. So to give you an idea of the power of the business, so currently they're doing about $300 billion in revenue. By FY21, they're estimated to be doing over $400 billion worth of revenue. So the numbers are simply staggering. If I look at the segments of Amazon, online stores have traditionally been about 70% of their earnings, 60%. They're now about 50% of their earnings. So proportionally, they're declining. Amazon Web Services, AWS, is sort of the business area that is most exciting to me, and it's one of the areas that is growing pretty exponentially. So back in 2013, they were doing less than $5 billion revenue. They're going to be doing $35 billion. They've done $35 billion revenue in FY19, and that number is growing significantly. One stat that I read recently really caught my eye and sort of explained why these web services, the use of technology, the use of streaming, the use of the internet, etc., is growing so exponentially. So over in the US, video streaming demand or use of video streaming sits at about 240 million hours per day. That number has increased to about 300 million hours per day during COVID-19. So I think one of the things that have come out of this changing dynamic associated with COVID-19, how we work, how we interact with others, how we get our entertainment, etc., is that there's going to be a growing prevalence of use of technology, growing prevalence of use of online. So Amazon Web Services is very much in the box seat to take advantage of that. So going back to Amazon, I think it's a stock that we need to own in the national portfolio. It's exposed to 2 really strong growing areas, that being online shopping and the other one being the use of the internet to consume things. So whether that's work or entertainment, etc., the trends there are only growing. One stock that also has exposure to this thematic is the Trade Desk. So the Trade Desk is a company we've added recently to the international equities portfolio. Bear with me, I am going to get onto domestic stocks for those that are focused on domestic market very shortly. But I just want to think about, expand horizons. So at Market Matters in the last 6 months to a year, we've introduced the international portfolios, and we're trying to expand the horizons of Australian investors into some of the areas that are truly, they're exciting areas to be thinking about and to be investing in. So the Trade Desk is what they call an ad tech business. So advertising technology. If you've got a huge amount of people moving from consuming traditional media to be consuming streaming content, so online content, then that changes the advertising dynamic. Gone are the days where a large business now puts unless you're Jerry Harvey, of course, puts a huge amount of ads in newspapers. They cross their fingers and they look to see, they hope that it's had a positive impact on their brand and on their sales. Online advertising is so much more data driven than that. So, and the Trade Desk is a business that underpins those data driven decisions in advertising. So it's a platform that makes advertising as relevant as possible to the consumer. And it underpins, they work with all the world's largest brands. They're a big business. They operate in the US, in Asia. They've got an office here in Sydney even. And it's a business that is very much exposed to the changing trends between how we consume our media, how we work and live our lives moving forward. So this is a business that we've bought recently. We're bullish on. I think it'll go and trade to new highs and continue on with that. So it's a really interesting business. I could go into the financial analysis pretty quickly in terms of Trade Desk, but the revenue growth has been pretty phenomenal in this business. It does revenue of 600 odd million at the moment. They're going to be doing nearly $1 billion of revenue in 2 years. So taking a business from 600 million to $1 billion in 2 years, the growth is simply phenomenal in this business. Moving on to a couple of domestic businesses that I don't think have the huge amount of growth that perhaps an Amazon or a Trade Desk is going to have, but I think they're pretty interesting nonetheless. So the first of those is Lend-Lease that we bought yesterday. So this is going back to a more of a sort of the speed and the sort of companies that we're used to investing in here in Australia. So Lend-Lease obviously very much exposed to construction, infrastructure here in Australia. They've recently raised capital at $9.80 a share. They raised about $1 billion. This is going to underpin sort of their balance sheet in the first instance, but also give them enough in their war chest to take advantage of this market downturn. We wrote a note last week around the differences between monetary policy and fiscal policy, suggesting that monetary policy had run its course. Monetary policy will continue to be supportive, and it has a really strong role to play to get us out of this COVID-19 slowdown. But I think the move towards fiscal measures will increase. Fiscal measures mean spending on infrastructure, etc., moving forward to create more sustainable growth for the Australian economy. So Lend-Lease is very much exposed to that thematic. They've got a well-capitalised balance sheet, and I think they're now set pretty well to grow from here. So Lend-Lease, we bought it yesterday. We're comfortable with that business, and we're bullish in terms of that stock. A business that we haven't bought yet, but it dovetails into what I was just speaking about with both Amazon and the Trade Desk, is Appen. We've owned this business in the past. We were almost going to put an alert out yesterday to buy it. It didn't come down on open as much as I had have hoped yesterday. I was a little bit pedantic in terms of our entry price, but we may pay up for this business. Appen's exposed to artificial intelligence, so the growth of artificial intelligence underpinning sort of the smarts to other businesses are pretty phenomenal. So the movement, one of the things that COVID-19 has probably refocused businesses' attention to is, what do we do when we can't, when people are working remotely? Can we have, what happens with it under a pandemic? Can we reduce the amount of staff that that we have, and can we utilize artificial intelligence more across our business. It's a growing area. It's a pretty complex area, but Appen is at the forefront of it here in Australia. So Appen's a really interesting stock and a business that we want to own moving forward. So we're bullish Appen, and we're likely to add it to the Platinum portfolio in the not too distant future. One of the more, I guess, mundane businesses that we've added recently to the income portfolio is Transurban. Transurban is a toll road operator. They obviously got hit very hard under COVID-19. Toll road usage fell off a cliff, and we're only starting to see numbers come back. We're only just starting to see the tentative signs of numbers coming back onto Transurban's toll roads. The businesses or the stock prices rallied from sort of above $9 to now be trading at $13. So it's not as compelling as it was when we bought it at lower levels. However, I think the future of Transurban is good. They've showed through this period that they can access cheap capital, even in times of financial duress. Their balance sheet for an infrastructure stock is reasonable. They carry a fair amount of debt, and this is a stock that we've spoken about at length in recent reports. They carry a reasonable amount of debt, but the stability of their earnings means that they can support that debt moving forward. So Transurban, from an income perspective, I think looks good. Still at these current levels, even though we've bought it at lower levels for the Market Matters income portfolio. And I'll finish off with a more traditional value-orientated play that we'd be happy to buy at these current levels is Smart Group. We do have this in the Market Matters income portfolio. It's a salary packaging business. They do a whole bunch of things like novated leasing, etc. That part of the business is struggling at this point in time, but the salary packaging area of the market is fairly resilient. The customer base that they have is fairly resilient, etc. So if I think about SIQ trading at $5.12, they're cheap. They're trading on sort of on 10 times earnings, and they're expected to yield around 8.4% going forward. So this is a business that, from a it's not sexy. It's not going to grow exponentially, but it's cheap. And if I look at trading on an estimated P of 11 times, and that's on these earnings that have been revised lower. So if I look at their valuation from a historical standpoint, they traditionally trade on sort of 15 times earnings. They're trading on 10 times earnings at the moment. So they're cheap relative to the market, and they're cheap relative to themselves. So one of the interesting things about the market at the moment is that we're all getting hooked on what the earnings are likely to be. I read a heap of analyst reports around earnings, and quite frankly, I don't think anyone has a handle on what earnings are going to be. That has meant that the market PE has gone higher, earnings expectations have gone lower, and we're getting a growing consensus that the rally in equities has been well overdone. I'm not as negative as that in the market. I've been bullish in the short term simply because of the underpin nature of the market by stimulus. So the fact that everything I read is also negative, people questioning this rally, etc. So I guess I just wanted to give a brief outline of 6 stocks that I thought looked really appealing at these current levels. Amazon is a stock that we don't own. We're going to buy in the international portfolio. Trade Desk is a stock that we've just bought that I'm really positive and optimistic on moving forward. We spoke about Lend-Lease, which is going to benefit from the infrastructure spend here in Australia as the heavy lifting moves from monetary policy into fiscal policy. They've raised equity. They've got a good balance sheet. Bingo is the other one in that area that I like, that are exposed to the infrastructure spend. And then we tacked it back a little bit and looked at a couple of income stocks with Transurban, which we're bullish on. We did buy it at lower levels. It's not quite as appealing as when we bought it, but still I'd be happy to add it to portfolios at this current point in time. And then finally on Smart Group, a cheap value stock at this point in time, which I think has got reasonably defensive earnings. They've nearly got net cash on their balance sheet, and they're going to pay a really strong dividend yield moving forward. So stick 6 trading ideas for your Tuesday morning. Bye for now.